It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Hello out there and welcome to another episode of Macro Mondays. Well, that was a little bit of a lie because this time the show is not exactly hosted by Andreas Steno since he's out of the office. I'm running the office single-handedly this week, but fortunately I have Andreas with me on a call connection. Are you with me, Andreas?
I am, Mikkel. Good to see you.
Great. You too. It's not completely fair that I'm running the offices alone. You're the kind of guy who works even when on vacation. But yeah, it's good to be able to say that. So, Andreas, we're going to talk Gung-ho Summer this week. We'll get a lot more into that after the US CPI numbers. We're going to talk a little bit about traffic jams around the south of Africa. Going to talk a little bit about Bitcoin and then China for next week. Andreas, I've made a little promise to myself this week, and I hope you're going to help me keep it. No talk about Biden or Trump. We're talking about it every week. And in my opinion, I don't know if you agree with this, it has almost zero importance to investors right now. In the long term, obviously it does, but right now it's not something that should impact your portfolio too much. So no talk about Biden this week, okay?
Yeah, let's agree on that, Mikkel. And I guess I've said it before, but I stick to that view. The overwhelming base case for most of the macro portfolio managers that we speak to is that Donald Trump will win the election. That's essentially what everyone's planning for, and I don't think there is a major change around that topic right now.
Absolutely. So you'll get plenty of Biden coverage out there. Also in our shows, we'll probably get back to it, but no more for this week. Instead, we try to be as short-term as actionable as possible when reviewing the macro landscape. This also means, and I've been tending to forget this little disclaimer lately, that our trade ideas, the ones we present in the show on StenoResearch.com, they may be...
Sometimes may be good, sometimes may be shit.
Always great to have the great Italian maestro Gennaro Gattuso in there. That's just an important little disclaimer here. So, Andreas, we're going to talk the concept of a Gung-ho Summer. Just to reach back a little bit to last week, we were talking about our macro regime indicator. We were tilting towards putting it in Gung-ho territory for July, and I guess this CPI report basically confirmed that, Andreas. So what are your views on that?
Well, it did. And then markets kind of started disagreeing, which was slightly out of the ordinary. I have to admit that. I mean, I was sitting in front of the desk with the Bloomberg screens open and the trading systems open and all of that, watching the US CPI number, and it came in more or less as we expected it. It was a soft print by all means. The very initial reaction was very positive. So I decided to get into the car and drive for the vacation home. And then as soon as I showed up at the vacation home, as soon as I got out of the car, we'd lost $1 million. So it was kind of a roller coaster. And therefore, I mean, I still stick to the view that this is a gung-ho summer. And by gung-ho, I basically mean inflation coming down. That's pretty obvious after this inflation report. Liquidity is still increasing. That's a high conviction of mine as well. We can talk a little bit about the different types of quality of liquidity this week as well. But certainly liquidity is improving right now. And then growth is obviously still the part of the picture that we're mostly in doubt about. But even in a scenario where growth slows down during July and August, we still have that low inflation paired with liquidity increases. Typically a scenario that should be pretty positive for markets overall. So let's see whether it was just a brief glimpse of negativity after that inflation report. That's still my best guess, essentially.
But as you said, Andreas, you seem to be a little bit alone in the woods with that assessment. Markets went in the other direction. What was that all about?
So, Mikkel, if we start with the inflation report and the
Mhm.
details, I know you've brought the table of the details of the
Exactly, yeah.
CPI report. Um, I mean, first of all, it's the first time in quite a while we've seen a negative print month on month. So basically, a deflationary print, very driven in headline terms by energy prices falling. And we know that there's a time lag between the oil price and the retail price of diesel, gasoline, etc. So I don't think we should expect another drop in July and August. That's basically what I'm saying. Then we have declining prices of used cars, new cars, stuff like that. So durable goods, right? And then, which was kind of the odd one out again this month, we had a decline of 0.5% in transportation services. And those of you who listen or watch this show each and every week will know that we had a lengthy discussion on the cost of insurance. Was it a few weeks back, Mikkel?
Yeah.
But it was actually not that cost category that dropped this time. So it increased on the month, this insurance cost category for motor vehicles. But public transportation was essentially on the floor in June, and I think that was kind of a surprise to many. Airline fares were down, I think it was 3.5% ish, which is also a bit strange, given that we see very very strong congestion in airports, loads of flight tickets being sold, etc. But apparently at lower prices. So again, I struggle to see why it's bad news. I mean, wouldn't you be happy if you bought the ticket that you, you already planned to buy for your yearly trip to Malaga in Spain cheaper than otherwise? I mean,
Absolutely. Yeah.
it should be net positive, right?
Yeah.
So I'm still a little bit puzzled why markets were so reluctant to celebrate this. Uh, when we look at like typical patterns around a soft CPI surprise, I've brought that in the next table, Mikkel.
Mm.
We typically see, especially consumer discretionary stocks, but also technology stocks performing when inflation drops, basically, right?
Mm.
Uh, we saw the exact opposite pattern after the release year. So even though we got macro right, we got markets wrong, at least initially, which is something that you obviously need to assess on a running basis because correlations are not stable. Um, and I've been spending most of the weekend trying to figure out why this happened. I guess the vanilla explanation is that markets were positioned for a soft inflation report already ahead of the release. Um, Another potential explanation is that disinflation is good. So inflation coming from say 3 to 4% to 2%, that's good. But as soon as you see inflation below zero, deflation, that is somewhat scarying, and could also mean that the inflation dynamic has turned a bit recessionary. So at least that's the kind of explanations I've been able to to sort of come up with. But I'm still of the view that this is a much more like natural disinflation process due to healing supply chains, due to normalizing labor markets and all that. I'm not overly scared that this is a consequence of a landslide in activity.
I mean, if we are in a gung-ho summer, the best time to
Mm,
be in a gung-ho summer is if everyone else thinks we're not. So
sure.
let's see about that for the coming weeks, Andreas. Um, Also, a point you made in an article on our website was that it's still essentially September or nothing for Fed cuts. That's still the base case. How do you view this for the second half of the year?
Yeah, I mean, we had Jay Powell taking center stage. Was it on Tuesday or Wednesday in the Senate? And that was ahead of the release of the inflation report. And he started. sounding the alarm to a certain extent on the labor market. At least we know now that the unemployment rate is higher than what they assumed already in June, and now there's actually a feasible path to inflation printing below their projection as well, meaning that once we get to September, they'll have to revise inflation down, they'll have to revise unemployment up. Essentially the perfect excuse to deliver a rate cut, right? So, I mean, we've been very hell-bent since the early innings of the year that this cycle didn't really lean in the direction of rate cuts. I am now of the view that an insurance cut in September is a done deal, especially given how Powell communicated last week. And therefore, I mean, they've been offered the excuse to cut rates before the election because of inflation dropping below their projection, because of unemployment reaching levels above their projection. So if I'm allowed to don my tinfoil hat for a second, and I actually said that after the June projection update from the FOMC, they deliberately put a very, very high inflation forecast and a very, very low unemployment forecast ahead of that September meeting to get an excuse to cut, because now they can use sound economic arguments to cut instead of being accused of intervening in the election process, basically.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
And this is usually where you would have a bunch of questions for me surrounding the presidential election. We'll save that for later. A lot of coverage of that around. We want to present your listeners with some bit more unique analysis. And one point of analysis we have here has been really, really interesting this week, and something that a lot of our professional customers are focused on, Andreas. Container crossings around Cape of the Good Hope. That's very, very specific. Essentially, we know that a lot of container ships, or almost all container ships, going from Shanghai to Rotterdam or other places in Europe, have been diverted from the Red Sea Suez route to going south of Africa. That's all fine and good. Takes a little longer. It's a little more expensive. Okay. It seemed that freight rates had found some sort of new level for this, maybe increasing a little bit. But then a storm hit just south of Africa, and that's the thing with container ships. They have to go through through stormy waters sometimes, and this caused the number of container crossings around the Cape of Good Hope to absolutely plummet over the past weeks. Yeah. This might be very, very short term. I just brought on a map from Bloomberg as well, where you can see it's an absolute traffic jam just to the east of the southeast coast of South Africa. So, Andreas, I know we've been talking about this all year, but this is surely another problem for international shipping. Should be another problem for consumer prices in Europe at some point.
Yeah, and potentially in the US as well, right? I mean, Mikkel, first we had the issues around the Panama Canal starting late last year due to the drought in the region. It's still an issue. We still have fewer crossings through the Panama Canal than usual. Then the Houthis started attacking container ships in the Red Sea. Was it around New Year's? After the Gaza-Israel conflict flared up. And then this route south of Africa around the Cape of Good Hope was essentially the only well-functioning route. And then all of a sudden a major storm arrives. It seems like when it rains, it pours. I think that's how you say it in English, right?
Yeah.
It's so typical that once you have issues surrounding geopolitics, then all of a sudden the weather is not willing to play ball either. And so basically what we're seeing right now is an acceleration in freight rates from already exceptionally high levels. And this time around, it's actually not positive for the shipping companies. I mean, fingers crossed. But I mean, a storm is probably transitory, right?
Yeah, should be.
At least you shouldn't expect that to be a permanent problem. But we're talking about a storm on top of already existing delays, on top of already existing capacity issues. So this is something that will have to feed into the price of goods at some point during the second half of the year. One thing to note, Mikkel, you'll see these rising transportation costs in PPIs before CPIs, so the producer price index. And you'll probably see it first in China. We've typically seen a pattern of, say, 6 to 9 month delays between freight rates and the producer price index in China. Because remember, I mean, China assembles a lot on top of manufacturing, right? So a lot of the components will be shipped in and then shipped out again. So it's very expensive if shipping is expensive in both directions. And there is a delay between freight rates and the price you'll see in Walmart. The question is how long this delay is, and it depends on a lot of factors. First of all, it depends on whether executives declare this situation temporary or permanent. If you're update your price list as a retailer, for example, you'd probably lean towards not reflecting freight rates until you're certain that freight rates have reached a new plateau, right?
Yeah.
Because you don't want to cut prices again because of freight rates, right? So that's question number one. We're now talking about at least a semi-permanent situation. I'll ask you about it in a second, Mikkel. The second question is whether your inventory cycle is strong or weak, right? If you hold a lot of inventory that you've bought at lower freight rates, you can keep your price low for longer. And we've seen decent sized inventories through the first half of the year. So my best guess is that the delay is longer than usual this time around. But by September, thereabout, you should probably expect to see a flare up of goods inflation right at the timing of the first rate cut from the Federal Reserve. And that could end up being quite an amusing market scenario where interest rates will end up going up despite a rate cut.
Yeah.
But we'll get to that in a few months, Mikkel. But Mikkel, the Panama situation, and especially the Red Sea situation, is obviously very linked to geopolitics.
Absolutely.
So, Mikkel, we've seen it on a headline basis again over the past couple of weeks. Israel, Hamas, they're negotiating. Could this spill over to the Red Sea conflict? Any updates there?
No, basically, I mean we're reaching a point where this war becomes the new status quo. I mean, in the Western mind, especially, we're very used to having peace or war, sort of a black or white. And that's also often the case with relatively shorter and high intensity conflicts, as we've seen in Gaza. But right now, the situation is, in my opinion, evolving into sort of a new status quo of low intensity warfare. I know it's still relatively high intensity, but it's not a set military campaign for Israel. They're sort of doing policing operations, doing pseudo military operations, but it's very, very hard to set an end date for this or to set a target of if they reach this, when they reach Berlin, they've won. That was the case in World War II. It's very simple. That's not really the case here. We're evolving into a scenario where Israel is de facto occupying square foot by square foot most of Gaza, and you need something to break that status quo. And a couple of months ago, that could have been a peace agreement. I think we are more or less beyond that. The Israeli government is probably also seeing benefits from turning this into a new status quo. So I don't really see that big. We could see some sort of ceasefire at some point, but not a big peace agreement. And that is probably what it would take for the Houthis to stop attacking international shipping. So I think the international community, the US in particular, is going to have to start to treat the Houthis as a separate problem from the Gaza conflict. And that's very complicated because you don't have as much leverage inside Yemen. And I think the US is currently engaging with a lot of the other Arab countries to sort of put pressure on the Houthis and to get some sort of deal with them. Eventually, some money will have to be sent their way, I assume. So it's the situation is growing even more complicated since the US haven't been able to reach a peace agreement in Gaza. That's the very sinister news, I'm afraid, out of that.
So, Miguel, I guess that basically means that at some point, executives in the Eurozone, executives in the US, they will have to accept that this is a semi-permanent situation. I'm
Yeah,
afraid.
yeah, absolutely. That either that or that you would have to pay some premium, basically some sort of sound toll to go through the Red Sea. It's a very, very complicated situation, and no one really has a good answer to it right now. The thing is that once this starts to hit consumer prices in Europe and in the US, it starts to become a real political issue. Right now, it's only something that we see on CNN, that some ships are being attacked. We don't really feel it in our everyday. Once that starts to happen, probably during the second half of the year, it becomes much more of a political issue to reach some kind of solution. So that could be a game changer over the second half of the year. But right now, it's basically a big chaos in shipping, I would say. Andreas,
Mikkel,
yeah,
Mikkel, one thing. I mean, we need to cheer up a little bit after this.
absolutely. We have a soundbite of the
Talk
week.
about the Red Sea. Yes, and Mikkel, let me just present that soundbite of the week. I received it in the inbox from one of our great clients, a great guy called Reuven, and I think it's from an account called Daniel Pico on X or Twitter. And it's, for those of you who don't know this this movie clip, it's from the German movie Der Untergang, sort of from the very final hours of Adolf Hitler's life in the bunkers under Berlin, and Hitler receives some bad news, and I think it's called Hitler Receives Bad News, this clip. But for this clip, where the account Daniel Pico has added some subtitles, we're talking about Hitler receiving bad news on the German Bitcoin holdings.
Es ist dem Feind gelungen, die Front in breiter Formation.
That's one of the best versions of this meme video I've ever seen, Andreas. Really, really great. You have to watch it in its entirety. So, Andreas, in just a second, we're going to call up our crypto analyst, Mads Eberhardt, to explain the situation a bit more to us, also to explain a very interesting trade he's put on our crypto portfolio. But Andreas, just to explain this very quickly, the German Federal Police seized, I think it was 50,000 bitcoins from a movie pirate website based in Germany, essentially, and now they're faced with, and I've worked within the Danish government. I know how I can just imagine how much of a hot potato this is. You're stuck with a bunch of Bitcoin. You can't really put it into your national books. You can't really use it for anything. What on earth do you do with it? You could destroy it, perhaps, like you would destroy if you seize cocaine, perhaps. But I mean, it's that they've decided to do the only sane thing, which is to dump it on markets, basically. That's what's happening right now. Incredible situation.
Yeah. And apparently, as far as I know, Mikkel, we're talking about one guy in Sachsen around Dresden running this piracy website. And he apparently handed them in when he was forced to. So he must have been a even a multi-billionaire,
Absolutely,
I think.
One of the richest guys in Germany.
So we're simply in the wrong business, Mikkel.
Absolutely.
That's also the conclusion here.
Absolutely.
Yeah.
So we'll just get our crypto analyst Mads Eberhardt on the phone just to get a quick analysis of this. So, Mads, we just saw the meme clip of Hitler in his bunker reacting to the German government selling off bitcoins. We just talked a little bit about it here in the studio. How has the sell-off affected the price of Bitcoin?
Yeah, so actually, every time one of these big entities, either it's governments or other entities, are selling Bitcoins, there are like two effects. One is the direct selling pressure itself, meaning that this is just shy of 50,000 Bitcoins that are suddenly being sold at market price. But then there's also the other effect, which is arguably even more effectful on the market itself, is the fear of this selling pressure, because these wallets are what we call in crypto term doxed, which means that everybody can follow these wallets. So every time we see that the German government, for instance, sends these bitcoins to exchanges or market makers, and then the market starts fearing that these bitcoins are about to hit the market. And I think especially this effect this time around has been the one that has impacted the market the most.
Interesting. And how long is this going to go on for? Do we know anything about that?
No, so we know that they started selling bitcoins about 2 weeks ago, and they are nearly done. I think this morning they had around 13,000 bitcoins left in their wallets, coming down from around 50k bitcoins. So I think this week we will be done.
Interesting. Mads, while we have you put out a trade alert yesterday. Even though you're on vacation, you're supposed to be on vacation. But anyway, you put out a trade alert in our new crypto portfolio yesterday on something called Maker. And for a complete crypto tourist like myself, what on earth is Maker?
Yeah, so basically what Maker is the third largest stablecoin. And what stablecoins are is that they try to sort of mimic what we define as a fiat value. So they often will they be have a $1 worth every time you transact with them. So they are basically dollars on chain. What Tether and USDC are is that they are pretty much centralized stablecoins. Maker instead is a decentralized stablecoin. So we actually took this token on our books because they for one, they generate substantial revenue, meaning that they actually trade at a price to earnings pretty much similar to many technology stocks. At the same point, they are also pretty bullish on these assets on chain, which we define as real world assets, which is basically assets that you can take from but you will define it the real world and then put them on chain. For instance, different invoices, equities, bonds, etc. And then we can use these to issue stablecoins. And I think BlackRock they made their first tokenized or real world asset fund this year. Goldman Sachs, they were out last week also saying that they were about to make their their first free tokenized products later this year. So I think, especially the second half of this year, we'll see a lot of different banks going into this area with world assets, and Mega is pretty much first in line to benefit from this adoption of these real world assets. And at the same time, also, Mega is about to see what we think is about to see a lot of growth as they roll out their future roadmap, which is called the Endgame.
Very interesting, Mats. Thanks a lot for joining us briefly here. As always, you can check out all Mats's crypto content on stenoresearch.com. Sign up for that. Have a great vacation until we see you again, Mats.
Thank you.
Great. So, Andreas, we're back in the studio after a little Bitcoin intermezzo here. Let's look a little bit ahead at the coming week, Andreas. We're looking towards China. The Chinese Central Committee is holding a policy plenum, I think the English translation is. That's basically a very big conference where the central leadership presents new policies, new directions for China. It's going to be extremely interesting. The backdrop of this, perhaps we should start there, Andreas, is that air pollution in Beijing, which is a gauge that we'd like to focus on a lot, is even stronger in June than what we saw in April and May. What's this backdrop? What does this tell us about the Chinese economy right now?
So, Mikkel, I think first of all, we can basically tell that the Chinese export industries are doing fine, given this pollution measure. They're not able to manipulate pollution over Beijing and other industrial areas. What they are able to manipulate is the GDP report we'll get this week. I mean, China is able to publish a GDP report less than 2 weeks after concluding a quarter. That makes no whatsoever sense, given that it takes months for smaller economies than China. So that's obviously mostly a manufactured number, right? What you can see from this chart on air pollution is that we had a massive industrial recession in 23 in China. They never reported it, but it was clearly there. Now we're seeing an acceleration again in China. It's actually positive. And we have this odd cocktail of a very strong export sector and local consumption being on the floor still. We got the export and import numbers late last week from China. Exports are up, imports are down. It's this odd cocktail of exports doing fine because of Western consumers doing okay. China's selling a lot of EVs, solar panels, etc., while their local consumption is down. And I mean, my personal opinion, and I'd like your take on it, Mikkel, is that as long as this export sector is doing okay, they're maybe not in a rush to do big fiscal stimulus, which is always what people hope for ahead of these conferences in China.
Exactly, I agree. Small disclaimer here is that we don't know what's going on in China politically compared to when we talk about the EU, US, even the Middle East. Just a little disclaimer out there. We're trying to understand things more often than not in hindsight, just to put a little disclaimer out there. What I think is happening, and what I've been saying for 6 or 9 months on this show as well, is that China's long-term game is to build their own middle class strong enough to replace the European middle class as their customer base, essentially. And I think the COVID crisis was sort of a reset for this. They hoped that once they were out of the COVID crisis, that now the consumers would be storming out of the gates, buying EVs, all sorts of things, and they haven't been. I mean, the Chinese consumers. I think that's pretty much what happened in 2023. They realized, okay, we have to return to the good old policy of selling goods or selling stuff to Europe and the US. And that's what's happening right now. And they're still very successful and very, very capable at that. So I agree completely. As long as they're able to do that, the short term is okay. The long-term issue is still that they need their own middle class, their own consumer class to demand more stuff, both in order to prop up that middle class, to make them wealthier, secondly, to support the Chinese manufacturing sector. Third of all, to rescue the housing sector. So I think that's what we're going to see, and that's where I agree with you. Short term, no stimulus, no. I don't think that China would engage in anything short term unless they really, really have to. The Central Committee likes to think 10, 20 years ahead in time, and that's, I think, what the stuff they're going to present this time is going to be like that. And if people are expecting very specific plans like we're used to from Western politicians and Western central banksters, you're going to be very disappointed, because that's just not how the Chinese Central Committee operates. It seems like they've tried to use EVs both as a pivot for exports. They've had some success in that, but also perhaps as a way of setting up a new Chinese dream for the Chinese middle class. That now they've moved into the cities, they've been moved out of poverty and away from being peasants. Now they should have cars. It's like the US in the 50s. Everyone should have cars. The Chinese consumers are just not buying that or buying them, not to the extent they would hope for anyway. So I think that's what we're seeing. What we're going to see from this policy plenum is most likely increased strengthening of the middle class, perhaps some tax reforms to send more tax revenue to the regions. That's something I'm really looking out for, because we know a lot of regions are really struggling financially. They were used to being able to basically sell land in order to raise capital, to build stuff, to create growth for the sake of growth. And that entire cycle has been broken now after COVID. So in many respects, I think COVID was a reset for that growth for growth's sake model. Now the Chinese are trying really hard to build their own middle class. That's the long-term issue of this. Short-term, I don't think we're going to hear anything about short-term stimulus. That would surprise me a great deal. Andreas, perhaps you could be a little more short-term than I've been here and talk a little bit more about currency, your home field. How do you see the current situation around Asian currencies, the Chinese yuan in particular? I know you have some points on that.
Yes. So, I mean, late last week, we probably saw intervention in the dollar versus the Japanese yen. By the time of the recording, we simply don't know whether it was official intervention by the Japanese authorities, but I think it was. We saw dollar yen coming back below 160. We saw dollar versus yuan retracing from 730. Both of those zones have been sort of intervention zones from local authorities. And I think this is the most important theme for your macro portfolio right now. What will happen to the dollar versus Asian FX? And oh boy, this has been the widowmaker trade of 2023. Every time everyone tried to jump the bandwagon on a stronger Japanese yen because of some signs of the Japanese central bank moving towards rate hikes, and so on and so forth, the dollar just annihilated all of those speculators every time. So here we are, July 2024, and I'm ready to file for a divorce if this is not the timing for a turning tide on this trade. Why am I saying so? Because we suddenly have softness on the dollar side of the equation, and that's been the missing link the entire time. We have inflation coming down in the US. We have insurance cuts upcoming from the Federal Reserve, very likely, at least in September. And on the other side of the equation, as we saw, Asian exports are surprising on the upside. And there is no urgent need for them to devalue their currency right now. Not an urgent need. There is a long-term need, but not an urgent need. And as soon as US fixed income is being bought into, we'll see these Japanese and Asian lifers hitting the sell button on dollar versus Asian FX due to rebalancing flows. So I think this is the major trend you need to watch. And here's the most important part of that. And this is where I'll get a lot of negative feedback in the inbox. The reason why gold has performed extremely well over the past 2 years, and the reason why silver has performed extremely well since late last year, is that Asian retail accounts, to a certain extent official accounts, have bought precious metals as a debasement hedge against these risks of a strong dollar versus the local currency. It's a way of gaining access to the dollar. You cannot gain access to the dollar versus Bitcoin in China. It's almost impossible, but you can buy gold, you can buy silver. if the tide turns on the dollar versus Asian FX, that natural bid for precious metals out of Asia is gone. So I think the dollar will weaken and precious metals will weaken at the same time, which is extremely out of the ordinary historically. But that's why we're here, to try and pinpoint new trends.
Absolutely. In just a minute, we'll get back to exactly how we express these trends in our own portfolio. But before that, Andreas, a meme of the week that I spotted on X that's very, very relevant to you, I think. Here we go. This is basically, I don't know what his name is called, an actor saying, very pleased that the bank says I can't afford a $1,200 mortgage, so I just paid $2,000 rent instead. Andreas, the reason I think you know why I posted this. I'm a big mortgage guy. I like to own my house. I think that's been the trend for decades, at least here in Denmark and in Europe. That trend is shifting a little bit. You might be going for a rented apartment as well.
Yeah, and it's kind of the same reason. So, I guess isn't it Zach Galifianakis or whatever his name is, between two ferns, right?
Exactly.
But you're right. But the interesting thing is actually that I think it's cheaper to rent than pay mortgages right now for the first time in a while. In this low rates environment, no doubt that you should take out a mortgage. But now that rates are higher, I don't think it's crystal clear. Which is essentially why we see rents catching up like crazy around the globe, right? But funny it is anyway.
Sell your house and buy other houses to rent out for that money, perhaps.
There you go.
Yeah. Now, Andreas, just to round off this show, let's talk a little bit about our portfolio. A couple of trends we've mentioned here. Obviously, the overall trend of a gung-ho summer, and also the trends in dollar yen and metals. How do we express them?
So we're short silver, we're short copper, we're long consumer discretionary still. We're short the US dollar versus LATAM FX, so Mexico, Brazil. Those are sort of the main pillars. So yes, we had a terrible weekend. I don't think any of this worked towards the very end of last week. We're starting to see some stabilization in it, and I still think it's the right expression for this. These trades will work if liquidity goes up, if inflation disinflates further, and if risk appetite is solid. And I mean, we've seen a few hiccups in this very clustered equity market already over the course of the spring and the early summer. So I don't think it's out of the ordinary that we saw one again, another hiccup late last week. It's nothing to worry about, yet. And well, as I said, I'll file for divorce if I'm wrong. Isn't that the best promise you could get? It's much more worth than dollars.
That's a big one. Yeah, and so maybe, Andreas, we should just have a disclaimer once more for all those of you who skip the rest of the show just to get our trading recommendations. Remember that our trade ideas might be
sometimes maybe good, sometimes maybe shit.
Yeah, Mikkel, they were not just shit last week; they were abysmal.
Dumpster fire, yeah. That's how it is sometimes. At least we're aiming to be completely transparent, at least for those of you buying our premium subscription. And we're also aiming to be very, very actionable in the short term. So we got through an entire show almost without mentioning Joe Biden being demented. I think that's a first for us, Andreas. Really, really good stuff. We'll be back next week. Until then, have a great summer out there. Have a great stay in the vacation house, Andreas. We'll see you next week.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.